Welcome to chapter 5. Let's understand that now what other type of instruments are traded on the stock market, or rather what are the types of markets other than stock markets. Because what is happening is many times when we say share market we use the term very loosely. So it includes bond markets, derivative markets, mutual funds, etc. 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 So let's try and understand the latest development. Of course, Warren Buffett calls it as weapons of mass destruction, derivatives. So what's a derivative? How does it work? So if we go to the technical definition, a derivative is an instrument which arrives its value due to change in underlying value of its asset. If we look at technical definition, it is too difficult to understand. Let me give common real life example. So let's say you have milk. Okay, you buy milk, you consume milk, then you ferment the milk to form curd. So basically curd is a derivative of milk. Of course, you can further derive butter and buttermilk out of curd. That is a separate discussion. But here to prove my point is that curd is a derivative of milk. If the milk is of high quality, of course it commands premium price, and the curd also will be of higher quality and it will also command premium price. If milk is cheap, the quality is lower, curd also will be quality poor and price will be cheaper. So basically there is some positive correlation between the quality of milk and price of curd. So here milk is the share, future is the curd. Yes, ladies and gentlemen, a derivative contract which is commonly traded on a stock exchange is known as a future. So future is a standard forward contract which has a standard size, standard margin, and it is traded on a stock exchange. Now the idea is that you cannot have derivatives traded perpetually. So there is an exercise date. So all these derivative contracts have a validity period, usually a month. So last Thursday of every month, these derivatives come closer to their expiry date. And these derivatives have two types of values. One is time value, second is intrinsic value. Now more about this we'll study in the advanced program. But so far as basic program is concerned, you need to know that in the world, rather than share market or popularly known as cash market, derivative market is far more larger. Now derivatives could be on anything. Okay. The Americans have taught the world that they can basically create a derivative and bet for or against anything. It could be rainfall, it could be who would be the next president of America or prime minister of India. It could be on things like survival or downfall of a company. And we know that the whole debacle of 2008, which led to a huge crash and Lehman Brothers closed down and AIG was bailed out, happened because of widespread use of unregulated derivatives. So in a way, derivatives are very dangerous for people who don't understand, because in the derivative world, you will not just lose the money that you have, but you can lose much more. Also the upside is like that. So it's a high risk, high reward game. And if you don't understand derivatives in detail, take my recommendation, stay away from it till you become a very savvy investor or a qualified investor. So we will talk about three types of derivatives today, rather four. First one is commodity derivatives. Second one is stock derivatives or share derivatives. Third one is index derivatives. And fourth one, the highest liquidity the market which possesses in the world, is currency derivatives. So let us talk about each one of them one by one. I would like to go in reverse order. Let's talk about currency derivatives first. So you know, in international trade, if you buy from America, you have to pay them in dollars. If they buy from India, they pay us in rupees. So there is always a rupee dollar exchange rate. Now this exchange rate can be converted into a derivatives called currency futures. So let us say I know that I have to pay an American company in US dollars after 3 months. I will try and find out what is the price of buying dollars today from the international market. Or I can buy a dollar future which will give me dollars 3 months from now. Depending upon what is my cost benefit analysis, I can hedge my dollar fluctuation and arrive at a particular price point. So basically currency futures are used for hedging. Let's talk about commodity derivatives. Now there are derivatives on food grains, fruits, rice, wheat, mango. Again, this work in the same pattern where the underlying asset is the price of a commodity. Then we talk about stock derivatives. Here, instead of currency or commodity, the underlying asset is a share of a company. And last but not the least, let's talk about index derivatives. These are derivatives where the underlying asset is a particular index, or to be very precise, price of a particular index. So let us say if I am buying a Nifty future, then in that case, the price of Nifty future is dependent on the movement of Nifty index. So this, ladies and gentlemen, is a very brief short introduction of derivatives. It's a highly volatile and a complex instrument, and I recommend you to educate yourself better before venturing out in derivatives market. In the next chapter, we'll see how retail investors can participate in the fruits of stock market without having too much of in-depth knowledge as well. So I'm looking forward to seeing you in the next chapter.